Okay, this is part 2 of Unit 4E, looking at income taxes. We just talked about deductions, standard versus itemized deductions. And we want to decide whether you should take the itemized or standard deduction in this case. So your deduction expenditures are $3,700 for contribution to charity and $760 for state income taxes. Your filing status entitles you to a standard deduction of $6,350. So if you were to itemize, okay, the itemized deductions here would be the $3,700 that you contributed to a charity, plus the $760 paid on your state income taxes, which is going to be $4,460. That number is definitely less than the standard deduction of $6,350. So you would want, in this case, to take the standard deduction because it is greater than the itemized deduction. So you always want to take the greater of the two when you are filing your taxes. Okay, now we're going to be looking at some tax rates. And so for our ordinary income, which is not looking at dividends or capital gains, which is a later discussion, the United States has a progressive tax income or income tax, meaning the people with higher taxable incomes pay a higher tax rate. The system works by assuming different, and here's kind of a key word here, marginal tax rates to different incomes or margins. And so, for example, suppose that you are single and your taxable income is $25,000. Under the 2017 tax rates, again, this is all changing with the new tax laws, but we are looking at 2017. What would happen is, so you're single, you would pay 10% on your first $9,300. So that's what this up to $9,325. You would then pay 15% on the remaining balance, which is $15,675, because this balance goes all the way up to $37,950, but you only make $25,000. So you are going to fall in the 15% tax bracket because that's the highest you go. So we're going to be using this table 4.9 quite a bit, and you don't have to memorize this. This will be given to you, but we're going to be using it to determine how much income tax you owe. And the first thing to make sure to identify when you are looking at this is what is the filing status of the individual. Because if you're single, you're looking in the first column. If you're married filing jointly, you're in the second. Married filing separately, you're in the third. If you're just a head of household, the fourth. So you do have to be very conscientious of that. And again, whatever tax rate you end up in last, that is the tax bracket that you are considered to be in. And at the bottom here, for a single, here's the standard deduction. For married filing jointly, there's your standard deduction. And then filing separately but married and head of household. And then the exemption all the way across is $40.50 per person. And so if it says you're married filing jointly with 3 dependents, then you would need to have that exemption 5 different times for you, the individual, the spouse, and then the 3 dependents. So let's calculate some taxes here that are owed. So Jean is a single, so we're in that first column, and had a taxable income of $35,400. So all of the adjusted, or the gross income, the adjusted gross income, and taxable income, all the calculations have been done for you. Again, the marginal tax calculation is based off of your taxable income. So $35,400. So what we do is we first look at the 10%. So the first $9,325 is taxed at 10%. So the taxes you owe are first 10% of $9,325. But we made $35,400, so we have to go to the next bracket because it's bigger than $9,300. So we say plus, and this next bracket peaks out at $37,950. Well, you made $35,400, or Gene made $35,400. So what we're going to do is, whoops, I forgot to put, so plus, now we're 15% times, and it needs to be the amount of money between that you earn between 35,400 and 9,300. So you just take the difference, 35,400 minus 9,325, and that difference right there will be how much is taxed at 15%. Notice I did not go up to the full 37,950 because Gene didn't make that much. Gene made 35,400, and so we stop where we peak out. So now if I compute all of this, I'll get $4,843.75. Now, most of the time, actually all the time, they are going to round to the nearest dollar for simplicity. So for 4,874 would be your taxes owed for that year in that situation if you were Gene. Okay, let's look at another one. So we've got Winoma and Jim are married, filed jointly. Okay, so there's key right there, with a taxable income of $105,500. They are also entitled to a $2,000 tax credit. Remember, tax credits come off the back after you compute taxes. You subtract tax credit directly from that. So married, filed jointly. We know their taxable income is $105,500. And so when we look at that, okay, we don't need to subtract off any deductions or exemptions or anything because that is the taxable income, so that's already calculated for us. So we come up here, married, filed jointly. Okay, the first 10% is on the first $18,650. So your taxes here are going to be 10% times $18,650 plus, now we got to go to the 15% margin, and the 15% margin for married filing jointly is $75,900. Now we make more than $79,500, or excuse me, $75,900. So we are going to take that cap of $75,900 minus $18,650. That's just finding out how much money is being taxed at 15%. So that difference there, again, is just that quantity of money is being taxed at 15%. Then the next one is up to $153,010. So this is now the 25% bracket. So it's a plus 25%. Now we don't quite get up to the $153,100. This couple is at $105,000. So since they don't quite meet it, but it still falls within that range, we take the $105,500, subtract the lower limit of the previous bracket, $75,900, and this will be your total tax. So follow your order of operations. If you have a scientific calculator, you should be able to type it in just as you see it. And when you multiply all of this out, you're going to get $17,852.50, and that's how much tax you owe, or these people, and they would be in the 25% tax bracket. Now remember, they had the tax credit, and tax credits come right off the back. So the total tax is going to be $17,852.50, subtract the tax credit of $2,000, which is $15,852.50. And again, round to the nearest dollar is what the IRS tends to do, or does. So $15,853 would be the total tax that is due for this couple that is married and filing jointly. Okay. So we've talked a little bit about tax credits and deductions. They may sound similar, but they are different. Okay. So I'll let you read through this, but just remember that tax credits, you subtract them at the end, but the deductions are calculated into your taxable income. So just make sure that you've got that portion down as to whether it's a credit or a deduction. If it's a credit, calculate all the taxes like we just did and then subtract it from the end. If it's a deduction, then that is calculated into the taxable income before you do those calculations. So if we look at this example number 37 here, we got Midori and Tremaine are in the 28% tax bracket and take the standard deduction. How much will their tax bill be reduced if they qualify for a $500 tax credit? Okay, again, it's a tax credit. It's not a deduction. So since it's a tax credit, then they would be given the full $500 reduction there. Okay, if it was or full $500 credit. If it was a deduction, then it would be less than that. Okay, so I'm going to say a couple things about Social Security and Medicare taxes, and then we'll have to end this video and start on a part 3. Now, in addition to being subject to taxes computed with marginal rates, some income is subjective or subject to Social Security and Medicare taxes, which are collected under the obscure name of what we call the FICA taxes, and that's the Federal Insurance Contribution Act. This goes back quite a long time. Okay, taxes collected under FICA are used to pay for Social Security and Medicare benefits, primarily for people who are retired. So you won't see this for a long period of time. Now, FICA taxes are calculated on all wages, tips, self-employment income. You cannot subtract adjustments, exemptions, deductions, or anything when you're calculating these taxes. They come right off of your gross income. But FICA taxes do not apply to income sources such as, so I guess I should not say your full gross income. It doesn't come into account when you look at interest, dividends, and profits. So it's more of your wages, tips, income, those type of things. Okay, now FICA taxes are paid by both your employers and the employee. You share this equally. So in 2017, again, and this number changes from year to year in a lot of cases, but for 2017, the FICA tax rates were 7.65% on the first $127,200 of income, with the employer matching that. So you pay it and your employer pays it. Now, if you have an income that exceeds $127,200, then you pay 1.45% on anything that exceeds that, and your employer matches that. Here's one thing that hurts a little bit. If you are self-employed, you must pay both the employee and the employer shares. So you actually pay double the rate if you are self-employed compared to those individuals who are not self-employed. Because again, if you're the employer and the employee, you have to pick up the 7.5% on both sides. So that's a look at the general idea of Social Security, Medicare taxes, often referred to as the FICA taxes. And we'll be doing some calculations in our next video on those.